Are you a self-diagnosed adult or the loved one or support person for a suspected autistic adult or child, and you're trying to navigate the medical complex, I guess I'll call it, in the United States to see if insurance will cover the autism assessment? If you are, you're going to want to stay tuned because this video is going to cover what questions to ask, what basic terminology to know, and what timing is important to know. In other words, this is going to be a primer on the U.S. health insurance side to make sure that when you're quoted a price, that you fully understand, is that price with insurance applied? Is it that price if you haven't had any other medical expenses that year? Is it that price if you're going in and out of network? All of the nitty-gritty that's important to know for any type of expensive procedures, tests, etc. within the United States healthcare system. If you already have an autism diagnosis and you have any other coexisting conditions, this might still be a really good video for you to watch if you're not deep into the details of how medical insurance works in the United States. Most people really don't have a need to know a lot of these things unless either they have something that's very expensive from a health perspective that they need to make a claim against, or unless they work with it, or unless you're an insurance wonk. I'll say that there. We might have some people whose special interest is insurance. I know a lot about medical insurance, health insurance in the United States system because I have worked with it in my career in a couple of different capacities. And so this is not just going to be about getting an autism assessment. It's going to really be about if you are quoted a price for any expensive procedure or test in the United States with standard insurance. Hopefully this video will help you understand what questions to ask and if you need to ask more than one time under different situations. So stay tuned and we'll tackle this head on. As with anything that deals with medicine, health, anything like that, I have a couple of disclaimers that I need to go through. The first is that this is about U.S. health insurance and providers. It is not a resource to be used in other countries. I am not the right resources to talk about the health system of any place but the United States. The second disclaimer is that any definitions, examples, figures I use are all for illustrative purposes, and they are not the specifics per se of your health insurance plan. So if you do have questions about your plan or a price that is quoted to you by a provider, you want to go back to the source. That could mean anything from calling the insurance plan itself, the carrier, or it could be if you have employer-sponsored health insurance, that might mean contacting the benefits administrator or the customer service arm of the benefits administrator for the employer. And lastly, and this is important, any definition and basic thing that I talk about with health insurance in the United States assumes that we're talking about a health insurance plan that is in compliance with the Affordable Care Act in the United States. After the end of the tax penalty for not having health insurance, there are some other plans that have popped up, and I think will continue to pop up in the United States that have other limitations to them outside the scope of the Affordable Care Act. And so do know that whether you're talking about getting insurance through an employer, getting insurance through the health exchanges, or just on the open market, it is really important that you know if it meets the minimum requirements of the Affordable Care Act. Most employer-based insurance does. And of course, on the health exchanges, those exist because of the Affordable Care Act. Where you may find one a little bit more that is not compliant with the Affordable Care Act is if you've purchased it just straight out on the open market. Okay, so let's get into the important things to know first. The thing that made me want to create this video is that I have heard online, both in forums, online discussions, other autistic content creators, parents of autistic children or suspected autistic children, all talk about how expensive it is to get an autism assessment in different places. And throughout the whole world, there are different issues with this. So it may be a long wait time. It may be that a plan is not going to pay for it. It may be that there is a set of limitations to why it's not paying, etc. And so it really got me into thinking about ways that I can add value to this conversation. So the first thing that is important to know is that even before we get into the terminology that I need to explain to lay some groundwork for this conversation, if you have ever been told by a provider that your insurance will not pay for an autism assessment, or really any other large medical expense for that matter, that doesn't necessarily mean that it's not a covered expense and that it wouldn't pay out in different circumstances. So the purpose of this video is to help you understand what questions you need to ask if you are quoted a price that you cannot afford. So the first, this is all going to be in layperson's terms. This is me explaining it. It's not formal by any means, but a covered service. So let's talk about what that means. A covered service is something that in the plan documentation, usually called a summary plan description, there's a listing of things that your insurance plan will cover and how much it will cover and under what circumstances it will cover a particular procedure, a medication, type of visit, and so on. What that means is that if you meet the criteria of what they say needs to happen in order for it to be covered, then all that means is not necessarily that they're going to pay for it. It means that you will get a negotiated price that anybody in their network of doctors and facilities has agreed to accept as their payment for being in that network, if you're talking about an in-network provider. We'll discuss out-of-network providers later because I don't want to get too confusing in the beginning. So if they say it's not a covered service, then the question I would ask if I were on the phone with the insurance company or with the benefits administrator at an employer is to ask, I would like a copy of the summary plan description, and I'd like you to tell me what page and paragraph number you're looking at. And there should be a list of exclusions for things that are not covered or not always covered. And there may be certain criteria that have to be met for it to be covered. A really common example is what's called a preauthorization, that before the insurance will pay for something really large, basically the provider needs to submit to the insurance company that they intend to carry out this expensive test or procedure, and they wait to actually do that test or procedure until the insurance comes back and says, yes, it's covered, this is what we're going to pay, or no, it's not covered, we're not going to pay. And most providers will not go through with any kind of expensive testing until they get that information from the insurance, because it's in their best interest that they're going to get their money. And if a test is, I'm going to throw out the number $5,000. I've heard that number a lot online. I will tell you that I don't know necessarily that that is a standard rate anywhere. The negotiated rate when I had my autism assessment with the insurance was considerably lower, and the price without insurance was considerably lower than $5,000. So that also goes to, if you've been quoted a price in the thousands of dollars, it may also benefit you to try other providers, because if they're in network, there's a price that they have to agree to receive for payment, a total of what the insurance pays and what you pay, in order to be in part of that network with that insurance. If they're out of network, they don't agree on a price like that. And so in either event, most places will not do any kind of expensive test until they have the results of a pre-authorization back from the insurance. And in the case of an autism assessment, it's pretty common that that provider will give you a call or will send you a letter in the mail or leave you some sort of a message on an online portal that says, okay, this has been approved or it hasn't been approved, and here is what your part of the cost would be. The big thing in this video to know is that just because they tell you that's your cost, as long as it's a covered service, it may not be your cost depending on when you get the test. So the next section is going to talk about the timing of when a covered service may be more or less expensive and under what circumstances. In this section, we're going to cover two terms that you'll want to know with any expenses you have from a medical perspective, regardless of if they're large expenses or not. Those two terms are deductible and out-of-pocket maximum. A deductible, in general terms, is the amount of expense that you have to incur in that plan year that's your responsibility to pay before the insurance will pay any part of the cost of any covered service. Sometimes there is a separate deductible for prescriptions than for medical services, and some plans lump them together. The second term is called out-of-pocket maximum, and that term means that within that plan year, there's a dollar amount that the plan has termed an out-of-pocket maximum. Usually there's a different figure for in-network and out-of-network, just like a deductible would be. And what that number represents is that's the most that you pay in a plan year, regardless of how much expense you incur. So why these two terms are really important is going to really depend on when you asked about the cost of an autism assessment. So it's fairly common that a plan year starts on January 1st. That's not always the case, but most plans, the beginning of the plan year is January 1st. So you for sure want to know that that's the case, whatever date the plan year begins. And this is it's a 365 day plan year. From the first day of that plan year, even if you're on a copay plan, a copay is a flat amount that you pay for a service without there being any sort of a split in percentages. So some plans are designed to where things like a doctor's appointment may have a copay. Like every time you go to the doctor, maybe your general practitioner, primary care physician, maybe you have a $40 copay, and that's what you pay every time you go to your primary care doctor, regardless of what you're being seen for in their office. Maybe a specialist, you might have a higher copay. You know, it could be anything from $40, $60, $70, $80, $100, whatever the copay is. Every plan is designed differently. But you do want to know a combination of three things. You want to know what your deductible is, what dollar amount that is, as well as, and we'll break that down a little bit more in a moment, but you want to know what the dollar amount of your deductible is. And I'm going to focus on in-network services. Again, those are services where the providers have agreed to take a specific price in order to be a part of that network with that insurance company. You want to then know if there are any services that are covered before the deductible kicks in for in-network services. So I have seen it both ways. I have seen plans that have maybe $1,000 deductible, $2,000 deductible, and so on. And that only applies, let's say, to things like a hospital stay, expensive medical tests, lab work, and so on. But if the person just goes to the doctor, then they're paying that flat copay amount. That's one very common way that plans can be designed. Another way that is very common that they're designed is that nothing pays until the deductible has been met. Period. Full stop. Until you've paid out of pocket, however much that deductible is, you're going to be on the hook for all of it. But remember, that's being on the hook for the negotiated rate of a covered service. And that's super important because if somebody decides not to have insurance at all, or they have a plan that's not a covered service and they're being quoted a dollar amount, you're being quoted whatever price that provider wants to charge. And they can decide whatever price it is. But if it's covered, a covered service, and the deductible has been met, then usually there's this other thing called coinsurance that I'll get into a little bit more in the next section. But you want to know, again, what's the deductible amount? Is my plan designed to cover certain services before the deductible is met? And you want to know with the deductible, the other thing I would ask is, are you looking at an individual deductible and are you looking at a family deductible? So if I'm a single person and I have my own insurance plan, whatever deductible amount that I'm given is going to be the amount that we're talking about. But let's say you have a spouse or domestic partner and there's two people on the plan. Let's say you have children on the plan with you, or let's say you're on a true family plan where you've got 2 adults and any number of children. If you're on a family deductible, plans can be structured in a couple of different ways that are common. There may be other ways than what I'm saying, but these are the two I've seen the most often. Either the entire deductible has to be met before anybody in the family has any insurance payment made for any, services, labs, hospital stays, tests, and so on. Or they'll do this thing called an individual component of a family deductible. So what that means is a family deductible is typically a higher dollar amount. Lots of times it's double or triple the amount of the individual deductible. So if my individual deductible, let's say, is $2,000 and I have to have $2,000 worth of expenses before my insurance pays anything out, and then I have a family plan for nice round even numbers, let's say that my family deductible is $4,000. So with that example, some insurance plans will say no. Like, let's say it's me and my husband. We've got a $4,000 deductible. We have to have $4,000 worth of expenses before they're going to pay anything. And that's $4,000 of negotiated rate expenses. Some insurance plans, though, will do an individual component. So for plans that are set up that way, using our example, if we've only got 2 people on the plan, they'll still carve it out that each person has a $2,000 deductible. So if I have a hospital stay, my expenses start to have payment by the insurance company after only $2,000 of expenses have been paid. And then my spouse's, let's say in this hypothetical example, his services start being paid for after he's met $2,000. And if you have a family where you've got adults and children on a plan, if there's an individual component, it may not necessarily be the number of people in a family. So if you've got 5 kids versus 1 child, usually they'll give you an individual component number that just basically represents what one person, like that each person has to meet that amount before things are covered, unless and until the family deductible has been met. Because if you've got a lot of kids and each one meets that individual component, it'll add up to the family deductible probably faster than if every single one of them hit their individual component. Why is this important? Why am I getting in the weeds with this? Well, if you've ever inquired about the cost of an autism assessment or any other large procedure or any other type of service, it could be physical therapy, it could be lab work, whatever it is, if you're quoted a price, especially if your plan works where nothing is covered until a deductible is met, they might very well have told you at that provider's office that, you know what, to get this autism assessment is going to cost you $5,000. Because what they've done is they pre-authorized it with the insurance plan. The insurance has gotten back to them and said, yeah, we're not going to pay for this until the deductible is met. And let's say the family deductible in that situation is $10,000. Well, if it's January 1st and nobody's had any expense, then that number you're being quoted is as of the date of the pre-authorization right away in January. And you might say, well, $10,000 is really high. Yeah, that's a lot of money. I'm not saying that it's not. I'm just throwing out a fictitious number here. The deductible could be $1,000. It could be $2,000. It could be $5,000. It could be, every plan is designed a different way, and you have to know what your deductible number is. That's a really important number to know. But that's one moment in time. And I'll give you a real world example, not from my autism assessment, but I had a very expensive medical expense that happened at the end of November last year. And I hadn't met my deductible. So that provider and that facility still have not billed me for that. And it is January 7th. So when all of my providers have been submitting claims to the insurance company, whatever their cost is, the insurance is paying that out, and that's counting toward the deductible. So even if they pre-authorized that the insurance was going to pay a certain amount of money, it might very well be that the insurance covers more of it, because by the time that claim goes through, I have met my deductible with other expenses, planned or unplanned. And this is really the crux of why I wanted to make this video. Because if you were quoted a price in January or February, assuming that it's a covered expense on your insurance plan, meaning it's something that if you meet the right conditions, that the insurance will pay at least some portion of it, but you've asked at the wrong time of the year before you've had any other expenses, then it might very well cost a completely different amount in terms of what you have to pay out of pocket than if that test was done toward the end of the year. And of course, plans can be designed in any number of ways, but that timing is important. The next section of the video is going to talk about terminology called coinsurance and how that applies to the number that you get quoted as opposed to a copay. Stay tuned. So as a review, we've talked about what a deductible is, which is the dollar amount that you have to pay in expenses before anything's going to be covered on the plan. And we've talked about what an out-of-pocket maximum is. And the out-of-pocket maximum, just as review, is the total amount that you have to pay in an entire plan year for every single service total. So I'm going to keep coming back to those two pieces of terminology and reminding you what they mean as this becomes a little bit more complex. So let's say you've met your deductible. Well, there's this other term called coinsurance. And what coinsurance refers to is that if it's not a service that has a copay, and remember, a copay is a flat dollar amount, everything to do with coinsurance, we're talking about percentages, and everything with copays, we're talking about a flat dollar amount. So most expensive things are on a coinsurance basis, like a hospital stay, an MRI, really expensive testing. Most of the time, that is what you're going to be talking about, a percentage of that covered service that you owe, and then there's a percentage that the insurance will pay of the negotiated rate. So plans, again, can be set up in different ways with different coinsurance amounts. And generally speaking, the more the coinsurance is, the more the premium is as well. The premium is what you pay to have the insurance. If it's an employer-based plan, that comes out of the employee's paycheck in order to have that plan. So, and again, to talk about a real-world example and what my journey has been like this year. So I had a high deductible plan when I started 2024. And the way it was set up was I had to meet, I believe the number was $3,200 of expenses before anything was covered. And everything was lumped in together on my plan: medicines, doctor's visits, hospital stays, tests, everything. I was not going to have to pay, the insurance company was not going to pay anything, not even a cent, until I had paid on my own for that much, the $3,200 worth of expenses. The trade-off for that type of plan is that the amount that came out of my paycheck every time I got a paycheck was significantly less than plans that were designed differently that my employer offered. So I decided I was going to use that, and I was going to, I'd kind of figured out with other planned things that were going to happen in the year that I was going to have at least $3,200 worth of expenses between doctor's visits and medicines and other things. But what happened was, and by the way, so that the way that plan was set up, it was a very good plan. So I still had decent premium payments, but the way it was set up is that I had 90% coinsurance, which meant that after I had incurred $3,200 worth of expenses that I paid out of my own pocket between January and December, any other expense I had, the insurance would pay 90% of that negotiated rate, and I would pay 10% to the provider or to the pharmacy or to the hospital or whatever it was if I was going to have a service. And I knew when I picked this plan in November that I was going to have more than enough expense that it would be worthwhile for me to pick that plan. It was going to be the best plan for me. Well, lo and behold, a couple of weeks after I picked my plan and I was locked in as per the federal government's guidelines, I was laid off. And I was on a severance to where part of what was agreed upon with the employer is that I would continue to have health insurance for a certain amount of time after my employment ended before the insurance would cut off. And so that spilled into 2024. So early in 2024, I knew I was going to have to get other insurance. And I knew I was bummed out because I was like, well, man, everything was going to be covered at 90% after I met this amount. And now I'm losing this insurance. And I had worked toward the deductible when it stopped earlier in 2024. And I had to start completely over with new insurance. Luckily, I was able to hop on my husband's insurance. And his insurance was set up more like a copay plan, where certain expenses, it was just a flat dollar amount to like go to the doctor, a flat dollar amount to see a specialist. But for other expenses like medical tests, blood work, hospital stays, an autism assessment, all those types of things, testing was set up, or so I thought, on a co-insurance basis after that deductible was met. It ended up, the autism assessment ended up working out a little bit differently, which is going to be, I'm going to save that part of the story until the very end of the entire video. But let's just for a moment say that anything other than a doctor's visit on this plan, the way it was structured, was I had to meet a new deductible. And then depending on what the service is, there were different co-insurance amounts. So some services might have been covered at a 90-20 split. Some services might be covered at an 80-20 split. And the split can be, I've seen 70-30, I've seen 60-40. And it's just going to depend on what the benefits package that an employer offers is, and or what a plan offers on the marketplace, and how much you're paying for a premium, and what plan you've picked based on your needs. So generally speaking, if you have a deductible and you've met it with other expenses, and then you have an autism assessment, if they've told you that autism assessment will be covered, but you have to meet that deductible first, then the next question you want to ask or find in paperwork is, what is my co-insurance percentage on my autism assessment? Or what is my co-insurance percentage on, and then insert in the blank, whatever expense, hospital stay, surgery, lab work, physical therapy, whatever it is. And the insurance company should be able to tell you that, or at least help you to find it in documentation. So how it works at that point is, just for I'll use 80-20. Let's say you're on an 80% co-insurance. So let's say, again, you're told that $5,000 amount in the early in the year, and you haven't met your deductible. But then you meet your deductible. You have expenses, planned or otherwise, and you meet the deductible. And then you're on a 70-30, or sorry, an 80-20 is what we're going to use for our example, an 80-20 split. Well, if I look at my calculator and I was quoted $5,000 as the cost, if that is the negotiated rate, which it may or may not be, but let's, for our example, say that it is. If I look at what 20% of $5,000 is, if I get my calculator out here, because I don't do math fast, well, that's $1,000. So if my plan is designed that way, that after I've met my deductible, the insurance pays 80% and I pay 20%, then that $5,000 I was quoted is no longer accurate. If I've met that deductible with other expenses, then rather than $5,000, I'm paying $1,000 in my hypothetical example of an 80% co-insurance situation. So if you've been quoted a high amount and you're like, whatever amount they quote you is really high, keep in the back of your mind that you might very well incur other expenses that you didn't count on that might make you hit that amount. It might be beneficial for you to then call the place up again and say, I want to schedule this. I'd like you to run a pre-authorization again to tell, so that the insurance approves it and you can tell me what I'm going to owe. And can I get in to have this done before the end of the plan year? If you can, then in our hypothetical example, you've saved yourself $4,000. And that's how coinsurance works. So whatever percentage they say an autism assessment would be at, some plans across the board say your coinsurance is the same regardless of service. And some plans will say for this type of service, we cover it at this percentage, and in other types of services we cover it at this other percentage. You want to know what the coinsurance is for whatever it is that you're trying to find out is going to cost you. Now, remember how I talked in the last section about out-of-pocket maximums. Remember, an out-of-pocket maximum is the most money you have to pay total combined for an entire plan year, and the insurance is obligated to pay the rest as long as it's a covered service. So I'll use an example. Let's say that, like I had a neck surgery, right? And I had that surgery done. And I wasn't planning on having a neck surgery, but I needed it and it happened and I had no choice. And it was just going to be, I was going to permanently lose function in my hand if I didn't have this neck surgery because I had an issue with a herniated disc. Well, depending on the circumstances of a surgery, it's very possible that a surgery or a hospital stay for a surgery, regardless of what the surgery or hospital stay is, it's very possible that with one surgery or with one hospital stay, you reach what's called your out-of-pocket maximum. So, if you have a hospital stay and the hospital facility charge is $15,000 and you have a $5,000 deductible and maybe a $7,500 out-of-pocket maximum, then all you're paying is $7,500 for the whole year for every single service combined. So if you're quoted a price for an autism assessment and it's early in a plan year and you go, oh, I can't afford that, that's way more money than I have access to. Great. You know your own finances, but tuck the knowledge away that if something else happens in that plan year that's unavoidable and you have a big expense like an MRI, like a hospital stay, like a surgery, like you get cancer and you need chemotherapy or something, really expensive things, that might push you to that dollar amount and it's outside of your control. And whether or not you can pay that is a completely different conversation than the one we're having right now. But in terms of what the insurance will pay, if you've hit that maximum and they're compliant with the Affordable Care Act, then you're golden. Everything's covered at 100% between the time you hit that out-of-pocket maximum and the last day of the plan year, which for a lot of plans is December 31st. So 2 pieces of advice I would give here. If you know that whatever amount you're quoted is a covered service, but it's way too expensive and you can't do it, and you just know for sure that you can't do it, I would ask the provider how long the wait list is. And if they say it's not very long, tuck that information away in your head. Because if you have something unexpected happen, let's say in February or March, and you have that hospital stay, you have that surgery, you have, that chemotherapy medication, as long as medication and medical are lumped together on your plan, sometimes they're not, whatever that big expense is, and you fulfill that in March or April, and it's completely out of your control. You didn't mean to get in a car accident. You didn't mean to take a fall and need surgery. You didn't, obviously didn't mean to have cancer or have something where you had to have a really expensive like MRI or something. But if it happens and they tell you, well, the wait list is generally only 3 months long, well then, by George, as soon as you're healthy enough to call, I would call and say, hey, I want to get on the wait list for an autism assessment, and then ask them to pre-authorize it again. And if it comes back that it's going to be paid for 100%, well then yay, you got it paid for at 100%. But a lot of people never know that because they've never hit that out-of-pocket maximum. Or the out-of-pocket maximum is still a lot of money and, people have already shelled out a lot of money hitting that. And if you don't understand the nuances of health insurance, might just assume, well, I can't afford this autism assessment because it's going to keep costing me money over and over and over again. When if it's the first time you've ever hit an out-of-pocket maximum, you're kind of surprised once you realize it because it's like, oh, I don't owe any more money. And, it's great. That's why those exist. That's part of why the Affordable Care Act was important as a law. Okay, so we've covered deductibles, we've covered out-of-pocket maximums, and that's a yearly thing. Out-of-pocket maximums are a yearly thing, 365 days. It's not rolling. There's a specific day your plan year starts and a specific year your plan year ends, and you have to know those dates and you have to know those numbers. And then there's coinsurance, which is the percentage that the insurance pays of that negotiated rate after the deductible is met. And then you pay the other percentage where it would total 100. But then there are copay plans. And a copay plan might be called an HMO, it might be called a PPO, it might be called an EPO. If you really want to know what they mean, it really doesn't matter for this conversation. I'll just come out and say it that way. If you're on a copay plan, regardless of whether or not your copays kick in before or after your deductible is met, because they can be structured either way, here's the question I would ask of the place where you're inquiring to have an autism assessment. Ask them, is this going to be billed like it's a test? Or is this going to be billed like it's a copay or like it's an office visit? I'm going to repeat that because it's a very important question to ask. Are you going to bill this like it's a test where I'm going to owe coinsurance after my deductible is met? In other words, a percentage of what that negotiated rate is. Or am I going to owe a copay, which is a flat dollar amount? And then you want to ask your insurance plan, well, do copays in this situation apply before or after my deductible's met? Lots of times copays kick in without meeting a deductible. It's really easy to assume that it would not be charged as a copay. But guess what? Some places that do autism assessments do charge them to the insurance like it's an office visit. That's the situation I found myself in. So when I knew I was going to lose that health insurance earlier in the year, I called the place that I was going to have my test through. And I said, look, I can't have this test right now. I know I'm not going to meet my deductible. I got really close, but I'm not going to meet my deductible on this plan I was on because I got let go from my job. I need to get on my husband's insurance. And we have a few different insurance choices that we can do through his employer. And literally the woman at the place cut me off and said, take a copay plan because we are going to bill this like it's an office visit. I kid you not. And that's not to say every place will, because every place is different. And it was psychological testing. It was with a psychologist. I actually had 3 appointments. And so I paid a copay for 3 different appointments. But y'all, it was like $40 a visit because they charged it like it was a copay. Whereas when I had that insurance policy from my other employer, that was a high deductible plan, and I said, hey, what's this going to cost? They quoted me a dollar amount that was significantly higher than that. And it was because that insurance plan was structured that nothing would be paid for until that $3,200 deductible was met. So yes, it was a covered service, but if I had had that done before meeting the deductible, like let's say on January 1st, it would have cost me $3,200 because that's what my deductible was. And then if there was a balance beyond that, then a percentage is, beyond that I would have paid. So you absolutely want to ask your facility, are you going to bill this like it's a copay? In other words, an office visit? Or are you going to bill this like it's a test? And whatever answer they give you, then you know. And you can call around if you live in a larger area, because just because one place bills it that way to an insurance plan does not mean that every place in the area does. Or it could mean that they bill it differently depending on what kind of insurance you have, because different places have different contracts with different insurance companies. And so I changed with one employer. I was with Aetna, and with the new insurance, I was with Blue Cross Blue Shield. And so those contracts with those facilities and doctors could look completely different in terms of how they have to bill certain things. So again, if I'm going to recap everything on this video so far, I'm going to say you need to know what your deductible is, meaning the amount that you have to satisfy before anything is covered. And it could be that certain things are covered, like at a copay, if you've got a plan structured like that. But generally speaking, large things like tests, hospital visits, surgeries, MRIs, lab work, usually you have to satisfy a deductible first. You want to know what that number is. You want to know what your out-of-pocket maximum is, so that if you have a really large expense that satisfies that number and everything else is going to be free for the rest of the year as long as it's a covered expense, then you want to know, okay, what's that number? And is this a covered expense? And then lastly, again, you want to know, are you going to bill this as like it's a copay? Or are you going to bill this like it's a test? If you have a copay-based plan, like an HMO, like an EPO, like a PPO. In general, and this is very general terms, HMOs, PPOs, and EPOs are designed with copay structures. And that's not to say that the deductible and copays don't apply for some things, but in general, their contracts tend to have, like, if you go to the doctor, you pay $40 kind of thing. You go to the doctor, you pay $80 kind of thing. You have an ER visit, it's a certain amount, things like that. Stay tuned, because in the next section of the video, we're going to talk about limitations, exclusions, and I'm just going to come out and say it, something that a lot of people might not be aware of, called a lifetime maximum. So stay tuned. Again, we're going to be talking about limitations, exclusions, and a piece of terminology called lifetime maximums. As promised, this section of the video, we're talking about limitations, exclusions, and what's called a lifetime maximum. So a limitation is something in an insurance plan that basically is covered in some situations and not in others, and a particular set of circumstances have to happen for it to be covered. So an example of this would be like bariatric surgery. Some insurance plans just plain cover it, but a lot of plans will only cover it. So in other words, there's a limitation. Some plans will only cover it if a person has a BMI that's above a certain amount. How this really comes to play with an autism assessment is that your plan may have limitations around autism assessments. So what you want to avoid doing is calling your insurance plan and just giving a really vague question and saying, are autism assessments covered on my plan? Because if you don't give it more context, the customer service person you speak to may not know that they have to give you context around limitations, because you could be asking in general, would they be covered for me? Would they be covered for my kid? Would they be covered, and so on and so forth. What I have seen most often where there are limitations are around age. So sometimes there are limitations in insurance contracts that basically say this is covered for a minor child up to a certain age. And generally speaking, that age can range anywhere from 18 to 26. I've seen that age range a little bit common because there's an assumption that some plans make that if a person is not an adult yet, that they may qualify for services that would be beneficial to them that, a 45-year-old person maybe wouldn't qualify for in greater society. So things like if you're thinking about an elementary, middle school, high school, college student getting an IEP, an individualized education plan, for example, in school, that sort of thing. Sometimes they won't do those unless you have a documented diagnosis. And so then the insurance in that state may cover it only until a certain age, especially if you're dealing with locally based insurance. So something like an HMO, those are generally local plans. Or if you're dealing with like Blue Cross Blue Shield, for example, Blue Cross Blue Shield is 50 different organizations. Blue Cross Blue Shield of Tennessee is not the same thing as Blue Cross Blue Shield of South Carolina, even though they've got some of the same branding and they share some of the same networks. There may be differences in one state to another with how a plan that is through a company like Blue Cross Blue Shield, that is not just one big company like we think of it sometimes with how they're branded. So you may hit limitations there. You may also hit exclusions. And what I'm going to say are the two exclusions that I have seen personally for autism assessments are to do with plan structure and negotiation with their network of physicians. So the best example I can give of this that is going to be practical is if you have an HMO or an EPO plan. HMOs tend to be local, EPOs tend to be a larger network, but what they share in common is that you only have coverage in network. If you accidentally go to an out-of-network facility or physician, you're stuck with a big fat zero. Doesn't matter what the service is, doesn't matter what you need, unless maybe it's a true life and death emergency. And some of those plans are structured where when you're talking about a true life and death emergency, breaking a leg is not enough of an emergency to go to an out-of-network hospital, according to a lot of these plans. Like we're talking heart attack, we're talking stroke, that kind of thing. So you want to for sure know, do I have an EPO, a PPO, or an HMO if I'm on a copay plan? Again, EPOs and HMOs, generally speaking, have zero coverage if you accidentally go out of network. A PPO can have out-of-network coverage. However, it's not a negotiated rate. It's this thing that they use called reasonable and customary. And without getting overly technical, if you go out of network, you're going to pay way more for any service or any medication on a PPO than you would if you go in network. And it can be a considerable difference, but there's some coverage. And typically there's a separate out-of-network deductible. And so a lot of people end up footing the entire cost of services that they have because they haven't met their out-of-network deductible. Remember, the whole video up until this point, we've been talking about in-network services. In-network meaning their network of doctors and facilities has agreed to set rates for different services and different prescriptions. So the biggest mistake that people make with anything big is they ask a very general question, not knowing that they need to ask a specific question. So if you go to an out-of-network facility and you say, I want to know if my autism assessment is going to be covered. Well, if you have an HMO or an EPO and they're out of network, when they try to pre-authorize that, it's going to come back that it's not a covered service. It's going to be excluded. That's what an exclusion means. Or they might just outright say, we don't take this insurance, and they won't even pre-auth it. They'll just give you a price, and that's what you pay if you don't. It's almost like you don't have insurance at all in terms of what they're willing to submit to the insurance company for them to be paid. So if you go out of network, you may end up having to pay up front yourself and then submit a claim to the insurance company. and get reimbursed whatever they owe you after that out-of-network deductible is met and after they've paid what are called reasonable and customary charges. Reasonable and customary charges generally, in my experience, are not as good for the consumer as negotiated in-network rates. And those rates are going to change depending on where you are in the country as well. So, if there's a big multi-state company that does autism assessments, they're going to want to know what state you're in, because both in-network negotiated rates and reasonable and customary rates can change depending on where in the country you are. So if you have an HMO or an EPO, absolutely 100%, you want to find an in-network provider that you can go through, because if you don't, it will not be covered. It's a thing. It will not be covered. Zero coverage. And that is the big drawback of an HMO or an EPO plan, is if you have something happen that's unexpected, but is not a life and death emergency, you may be footing all the bill. Like I think I've told you before, I worked in customer service, and it is not an isolated thing. I have not taken just one call. I've taken many calls with many different insurance plans, with many different companies, where somebody breaks their leg, literally bones sticking out of their skin, and the nearest in-network hospital is 100 miles away, and they're expected to drive 100 miles to that hospital to get that bone set, or to have that surgery to fix that, because it's not a life and death emergency, according to a lot of insurance plans. So, if you have a PPO, and I haven't talked about high deductible plans yet, but if you have a PPO, you also want to know what your out-of-network deductible is, if you do intend to go out-of-network for anything. Now, a high deductible plan, like the one I had before I lost coverage from my job, from losing my job, being laid off, a high deductible plan, depending on how it's structured, may have both in-network and out-of-network coverage. And like a PPO, they can have separate deductibles and separate out-of-pocket maximums in the plan year. So the big thing that I would want to know if I had a high deductible plan, besides knowing what my deductible is and what coinsurance amount will be paid after I have enough expense to satisfy that deductible dollar amount, is I would want to know, is everything I plan on doing going to be available to me as an in-network service within the area I'm able to have transportation to get to? And then know that you need to go in-network if you can't afford to meet a separate deductible for that out-of-network service. And the out-of-network deductible can be significantly higher than an in-network deductible. Why I hope you're still watching this video, even if you've gotten the answer to what you started wanting to know at the beginning, is another thing that a lot of people really, really don't know, that I wish was more common knowledge, that I'm hoping this video will help with, is that even though people are required to stay in their plan for the whole year if they're with the same employer, if you've got employer-based coverage, or the whole year on the same plan if you've purchased a plan through the insurance marketplace, the Affordable Care Act insurance marketplace, even though you're locked in for a whole year, unless you have a life event like a marriage, birth of a child, things like that, does not mean that doctor's contracts necessarily coincide with a plan year. I have personally had it happen before where I was on an EPO where I had to go in network. Nothing was covered out of network. And I had a physician a couple different times who was in network for years and then decided to stop taking that insurance. Or they changed medical groups and that medical group didn't take that insurance anymore. So The other thing I would say that is a really important question to ask as you get closer to your autism assessment is to basically, you can call the insurance company or you can call the place where you're going to have your assessment. And if you really want to be sure, you can call both and ask, are they still in network? Now, the doctor's office likely, if they've pre-authed something, done a pre-authorization and quoted you a price for in-network, and then they become out of network, they have an interest in saying, hey, this is actually going to cost you a different amount of money. We need to let you know that. But if you've just asked a general question and haven't actually given them your insurance card, and you just call somebody up and say, hey, do you do autism assessments? What does it cost? I have XYZ insurance company. And then they might ask, well, what does it say on your card? Sometimes it'll say like what network you're in. They might give you a general like verbal estimate or something. But if they haven't pre-authorized your service and you haven't mentioned to them anything about your plan where, they've actually been in contact with your insurance company for something like an autism assessment or a big test, they're not going to let you know. If you just schedule an appointment and they're not on the ball and not doing their pre-authorization like they're supposed to, I have seen people get stuck with really big medical bills that have had that happen. So that's just good advice in general. And know that if you really, really, really like a doctor, they can decide to be out of network. And you're not privy to know what their contract is. So it may be in the middle of a plan year for you. Okay, so we've talked about limitations. We've talked about exclusions. I want to talk for just a moment about something called a lifetime maximum. If you have purchased a plan that is not in compliance with the Affordable Care Act, you may have a plan try to do this thing called a lifetime maximum that was standard fare before the Affordable Care Act, where basically it's sort of like if you've ever had orthodontia or you've had a child who's had orthodontia, they do lifetime maximums lots of times on dental insurance for that, where over the lifetime of that particular patient, the insurance will only pay out a certain amount, and then they just plain 100% stop paying. You don't hear about it as much anymore, again, because the Affordable Care Act eliminated it. However, if the Affordable Care Act ever gets repealed without a replacement that has a similar provision for lifetime maximums, I could see it coming back. And this is not meant to be a political video in any way, shape, or form, but the Affordable Care Act is a law, and every law in the country is subject to what lawmakers want to do. Replacing laws, repealing laws, changing provisions of laws, strengthening laws, weakening laws, whatever. So because it's a law, one of the provisions is that they put a cap on lifetime maximums. And this isn't necessarily going to affect most people who go for an autism assessment, even if the Affordable Care Act just ended tomorrow. But what used to happen before the Affordable Care Act is that it was very common for plans to have a $2 million lifetime cap. And after $2 million for that same patient, a plan wouldn't continue to pay. And people would run into problems with this who had very expensive conditions like cancer, like people who are on biologic medications that cost tens of thousands of dollars a month, people that have very rare genetic conditions that have to have, really expensive treatment because not very many people have it. Therefore, it's not manufactured at scale. And why I bring this up is, between now and the day each of us, passes away, laws can change. So if you ever hear of the Affordable Care Act being repealed, being replaced, or provisions being changed, one of the things you want to find out for sure are two things. Have lifetime maximums gone away? If they have, and you've already had things like cancer, like a very expensive condition, the insurance company could very well say, we're not going to pay for an autism assessment. That is going to be excluded because you've already hit the cap. That's one possibility. The other possibility, if the Affordable Care Act is ever completely repealed without certain provisions replaced, is there could potentially have pre-existing conditions come back. And I don't know exactly how that would affect an autism assessment because, either you're autistic or you're not. But basically, how I think it would potentially impact somebody is if they'd had an autism assessment, let's say as a child, and they were diagnosed, and then later a different physician had a different opinion and wanted to go for another assessment. Well, if they came back autistic again in the new assessment, then the insurance could potentially not pay. I don't think that'll be as big of an issue with autism personally as it might be with a condition like cancer, because cancer can recur, diabetes, things like that. The other way I could see it potentially become an issue is if somebody was autistic and they were diagnosed autistic and then later needed to go for some sort of therapy related to autism, specific to autism. I could see an insurance company saying, no, we don't cover the autism because it's a pre-existing condition. Again, a lot of things would have to change for that to happen, but I bring it into the discourse just because, we are at a change of political power right now in the United States, and regardless of how you feel about your politics, it's a factual thing that laws tend to change over time with different politicians, different parties being in power, and whether or not you agree with those changes or like those changes or voted for people that support those changes or not. Healthcare law is constantly in flux. COBRA wasn't always a thing. HIPAA wasn't always a thing. There's just laws that change. FMLA wasn't always a thing. So, the next section, is going to be the last one. And what I want to talk about in that section, is what to do if your insurance plan has, basically said, the reason we're not going to pay for this is that it's not a covered service. So it's not a matter of you haven't hit a deductible. It's not a matter of if, you haven't satisfied the in-network requirement that some plans may have. If they just outright say, this is not a covered service, there is one more thing that a lot of people don't realize about their health insurance that may or may not be something that you can take advantage of. And that applies to self-insured plans. So stay tuned. As I said in the last section, we are going to cover one more topic in this video, and it's about self-insured plans. So if you've never heard that term, another term that means the same thing is self-funded plan. And it sounds a little bit like it would mean like you pay for your own insurance, but that's not what it means. A self-insured plan is basically a plan in which the employer itself pays the claims. In other words, the employer is very heavily involved in the insurance plan design, like what things are covered and what things are not. And if you're not on a self-insured plan, then the employer basically buys an off-the-shelf insurance kind of product with a carrier, and it's just, hey, this is what we offer, and they say, okay, this is what we want for our employees, and they contribute a certain amount towards your premiums and whatnot, but the insurance company is 100% in control of what's covered and what's not. On a self-insured plan, the difference is that basically the employers have to bend to market pressures. And so I'm not saying this is an option that would necessarily help you in the short term by any means. But if you find out, and you could call your company's HR or their benefits administrator and ask, is our health plan self-insured or self-funded? If you're told yes, what that means is that unless you're able to change plans, like your spouse or domestic partner changes employers and you actually change to a different insurance plan with a different company that it could potentially be the same insurance carrier, but it would be a different plan. That can happen with a life event. It can happen every year during open enrollment, where you're dealing with a different insurance plan, and perhaps the excluded service is no longer excluded on this new plan. I mean, that's reasonably going to be the thing that's going to happen with most people. If they really need something covered, the way to get it covered is to change insurance plans. And because a lot of employer-based plans, they want your premiums to be pre-tax premiums that come out of your paycheck because it's advantageous to you. You save a lot of money that way. The government sets certain rules, and you can't just change health insurance plans willy-nilly. Like, you can only do it during open enrollment for the following plan year, and you can only do it during certain types of life events. So for the most part, you're going to be locked in. If you're told, no, this isn't covered, it's not going to be covered. But every year, companies who are self-insured or self-funded, it's up to them. They get to decide what they want to pay for and what they don't want to pay for. And an example of something that I've seen happen in a short amount of time relative to something a longer amount of time is when Roe v. Wade was struck down. I have seen insurance plans basically all of a sudden they get new provisions saying we'll reimburse a certain amount for travel for health services that aren't offered within a certain mile radius of where you're located. And I've heard of insurance plans outright saying it's for abortion. And I've also heard of insurance plans outright saying it's for anything that you can't find that's covered within a certain mile radius that will reimburse for like hotels and mileage and things like that. Or maybe we'll pay for an out-of-network service if there's no in-network service available. And that happened pretty quickly after Roe v. Wade with a lot of self-insured plans because companies have to bend to market pressures. So if they change it and it's pretty quick, they have a higher chance of retaining employees. And that's why companies do it, is they want to make their benefits package be as attractive as possible. And so if there are things that happen that would affect a lot of people, it's at their discretion to change. And I don't think it's a normal thing that you see intra-plan changes. I think the repeal of Roe v. Wade was an exception. I mean, it's not done a lot. Where I think you may have a little bit more footing if changing employers or your spouse or domestic partner changing employers isn't an option, particularly in the middle of a plan year, because let's face it, it's hard to find a job as an autistic person. It's hard to keep a job as an autistic person. And it's hard to find a job and keep a job right now, regardless of who you are. The market is not good for it, regardless of what the numbers say in the economy. So as a last-ditch effort or as advocacy work, what you could potentially do is ask your benefits administrator or your HR department of the company where you or a spouse or domestic partner work that you have your coverage through. You can ask, is there a mechanism by which we can ask for changes in the plan? And they may say yes, they may say no, or they may say maybe, or they may say yes, and then the way they give you isn't truly anonymous. So you do have to be kind of careful about this if you don't want your employer to know your health condition. And you might ask, well, if the employer pays the claims, I don't understand how this works. So basically, self-insured plans, because of HIPAA, are not allowed to know what your health conditions are as employees and as your family if you're covered through a spouse or domestic partner, or if you're under 26 and you're covered on your parents' plan or under, that kind of thing. Employers are not allowed to know what you are suffering from as a health condition and what medications you take. So it's not as if they are paying, my claims individually. What happens is the insurance company says, okay, according to the plan rules, we've paid out X number of dollars in whatever time parameter that they bill the employer, send us this money. And then the employer basically gives them whatever amount of money it was that was paid in claims. And so, as an aside, if you work for a company that has self-funded insurance, or in other words, self-insured plans, you are not only getting the value of your salary being paid to you and whatever they're contributing toward your premiums, because generally employers contribute some toward premiums, and what you pay is a percentage of the total cost. But they are literally also paying your claims. So if you've got a really expensive medical condition, they're paying your claims. So why I say I would be careful a little bit with this option is if you don't want them to know that you're autistic or somebody in your family member is autistic or has any other medical condition, because you're afraid that it will hurt you. And so if you just fill out an online form that says, this is what I want my insurance plan to cover, or you send an email from your work email address, obviously then they know that you have a vested interest in something being covered. They may not know why, if it's you, a family member, or you're an advocate for people with disabilities, any number of things could be true. But if you don't want them having that suspicion, then this is a little trickier. But what you could potentially do is find out what avenue that is. And if it's an email address, use an email address that's not your work email address. If it's a web form that doesn't require you to authenticate through a work email address, you could do it that way. You could write a letter, like snail mail type letter. Or the last thing you could do is take your employment elsewhere, because that's how employers bend really large scale. Because let's face it, market pressures are what change most things in a capitalistic society in terms of anything dealing with money, right? But a lot of people don't realize that their employers pay their claims. And so you may wonder, hey, I worked for one company, or my spouse or domestic partner worked for another company, and our insurance was really great. And then we worked somewhere else and the insurance, it didn't cover as much stuff. And what you may not know is that in self-insured plans, it's the company itself paying your claims. It's not the insurance company. It's your employer directly. I mean, it's not like, here's this off-the-shelf insurance product, to have X number of employees on it, you're going to owe us Y premium dollars every month or whatever. It's no, the employer pays the claims. It's just, they don't know which exact expenses go with which exact employee. And I don't know that they even get data on like, we paid this amount for cancer and we paid this amount for this other thing. They tend to be more generous with their plan because they want to retain good employees. And if you have a job that you work for particularly large organizations that have highly educated people that are in high demand, then market pressures tend to make those changes. And then, of course, like I said, you can always change plans, open enrollment or with the marketplace. If you're fortunate enough to be in a position to do so, right? Like not every adult is able to keep a job for medical reasons in addition to other things. And so you may not have the option to go on a plan from the other person. But if you do have that option, it's there. If you don't, you can inquire if I just drew a blank. You can inquire if your employer is self-insured or not. And you can always try again the next year. I think that's the other mistake that some people make, is that they try 1 year and it gets declined and they think, oh, well, this insurance doesn't cover XYZ service. And then if their spouse or domestic partner or they themselves work for that employer for a really long time, they just assume year after year that it's not going to be covered. And that's not always the case either. Again, because employers can bend to marketplace pressures. So, every year I would check. And every year, if you're getting turned down, I would ask the questions that were a part of this video before. Are you making sure that you're meeting a deductible? Are you making sure it's a covered service? Are you making sure that you're checking in network? All of those things. So I know this has been a long video. Thank you for sticking around if you've stuck through the end with me. Like and subscribe if this is helpful content for you. And I am appreciative of you watching, and take care.